Hi there. Real-world assets, or RWA tokens, are increasingly competing on something much bigger than price action. They're competing on whether institutional finance is actually willing to move on to blockchain infrastructure. This week, several developments test that thesis, from regulation and compliance to tokenized securities and institutional infrastructure. We'll look into those developments and then the charts of XRP, Chainlink, Ondo, XLM, and Quant through the Wyckoff lens. Securitize becomes public as institutional tokenization accelerates. Securitize completing the public listing is significant because it moves tokenization from startup territory into the public markets. Think of it like a private company moving into a glass building where everyone can now inspect its operations every quarter. From an MBA perspective, public listing improves access to capital while increasing accountability. If institutions continue building on securitized infrastructure, that will strengthen the broader investment case for RWA platforms and supporting ecosystems like XRP, Link, Ondo, XLM, and Quant. A certified fraud examiner would immediately ask a different question. Does public ownership actually improve execution, or does it simply increase expectations? Many financial technology companies have generated excitement during their listing process, only to discover that scaling regulated infrastructure is much harder than announcing partnerships. Institutional observers will likely monitor transaction volumes, customer growth, recurring revenue, and governance quality, not headlines. A public listing attracts attention, but regulation determines who is actually allowed to participate. That brings us to Europe's biggest compliance deadline. Compliance is rarely exciting, but it often determines who survives. When Europe's MiCA rules become fully enforceable, projects that cannot satisfy capital, reporting, and operational standards may find expansion significantly more difficult. History shows that regulatory tightening often reduces the number of participants before creating a stronger market structure. On the other hand, institutions generally prefer operating where the rules are clear. Banks, asset managers, and regulated custodians typically allocate capital after legal uncertainty declines, not before. From a fintech consulting perspective, compliance isn't simply a cost. It can become a competitive advantage if it increases trust and reduces operational risk. Evidence supporting this thesis would include increasing institutional participation after implementation rather than declining activity. Regulation creates the rules. The next question is whether the blockchain infrastructure is actually being designed to operate inside those rules. Mantra's approach focuses on embedding identity verification, KYC, and anti-money laundering controls directly into blockchain infrastructure. Instead of adding compliance afterward, the network attempts to build it into the foundation. From a systems engineering standpoint, reducing integration complexity can become valuable if financial institutions want to deploy tokenized assets at scale. Evidence supporting this view would include regulated institutions choosing compliance-native infrastructure over more generic alternatives. However, technology alone rarely guarantees adoption. History across financial markets shows that successful infrastructure also requires liquidity, customers, regulatory acceptance, and operational resilience. A blockchain can satisfy every technical requirement and still fail commercially if institutions don't migrate meaningful assets. Professional investors will likely monitor active usage rather than feature enhancements. Compliance may reduce one obstacle, but infrastructure still needs reliable data and investable products. That's where some of the largest RWA ecosystems enter the discussion. Infrastructure stories often sound compelling because they describe what could be built. The harder question is whether that infrastructure becomes indispensable. Chainlink's Oracle network and Ondo's tokenized bond products address two important pieces of institutional adoption, but infrastructure investments often mature over years rather than months. Institutional observers will likely watch transaction growth, integration by regulated financial firms, and repeat usage instead of partnership announcement alone. At the same time, every tokenized asset needs reliable pricing information. Without trusted market data, tokenized securities cannot function safely. Likewise, tokenized treasury and bond products help connect traditional fixed income markets with blockchain settlement. From an MBA perspective, these are foundational services. If the underlying infrastructure becomes industry standard, the entire RWA ecosystem, including projects such as Link and Ondo, could benefit from broader institutional adoption. Infrastructure connects markets, but ultimately, capitals need somewhere productive to flow. That brings us to tokenized lending and credit markets. Credit markets represent one of the largest opportunities for real-world asset tokenization. Platforms such as Centrifuge, Pendle, and TrueFi are working to move lending, receivables, and yield management onto blockchain infrastructure. If institutions increasingly finance real-world assets on-chain, blockchain could become part of the financial plumbing rather than simply another investment asset. Evidence supporting that thesis would include growing institutional participation, improving loan performance, and expanding issuance across multiple asset classes. However, blockchain technology cannot eliminate credit risk. A poor borrower remains a poor borrower, whether the loan exists on paper or on-chain. From a certified fraud examiner perspective, the focus should remain on underwriting quality, transparency, collateral controls, and default management. Historically, credit markets appear strongest during expansion periods. Stress cycles are where weaknesses become visible, making risk management far more important than headline growth. Now, let's look into the charts. Remember, you can join other channel members and get early access to these videos. You can also find my weekly write-up on Substack at XLM. Starting with the very first chart, Ripple. From a Wyckoff perspective, Ripple is entering the very early stage of accumulation, like we discussed a couple of sessions back. The panic over stage is getting close. Okay, so it may not be over yet, not until we see something called an automatic rally. So if we look at the 2022 cycle, from the panic sell whales buy period, that long red stretch, okay, to the panic over stage, the little bit of sideways bottoming out, volume dropping. That's one observation, by the way. Sometimes volume drop to a very low level. Sometimes we have a very short period of a volume spike where large commitment came in to buy the lowest point. Okay, that stopped the further dropping. So there are two different scenarios over here. But in 2022, that's scenario one: lower volume, price spread narrowed. That's what it is. And then the automatic rally came in. So that's the typical Wyckoff accumulation stages. What we haven't seen yet is this one. Okay, so while we're waiting for that, it doesn't mean the price has already bottomed. And even if automatic rally appeared, there will be subsequent tests to come back to the lower levels. Sometimes it can go even lower than the selling climax. So don't think there's no downside risk, even if selling climax and automatic rally has appeared. So in the case of Ripple, let's expect more shaking to come. All right. Daily chart. We already talked about this. It hasn't changed. Basically, we said Ripple has been in a downtrend, started somewhere in mid-May. It is still within this downtrend, okay, this short-term downtrend over here. After exiting, doing sideways and exiting from that sideways trend especially the confirmation came in the beginning of this month. The bulls tried to push the price back into the sideways trend channel during mid of this month, but they failed. They're now trying to defend the 1.05 red key level. You see the past 3 days, that line has been tested. We talked about this July 15 date. That's the 2C's decision if you're new to my session. So whenever we get to a triangle formed by a channel box, either ceiling or bottom, depending on whether that's an uptrend or downtrend, and a key level or an intermediate level. Okay, intermediate level is more like short-term. Key level is formed by a lot of trading activities in the past. Okay, you can find a lot of reference points back in the history of an asset or on a chart of a particular asset. So that's where we're looking at right now. The 2C's decision is continuation, the first one, continuation with this short-term trend, or a change, meaning breaking the channel box resistance, or sometimes if it's uptrend, that's the support. Breaking that and form another new trend. It doesn't always mean it's going to go straight up. Sometimes it's sideways, sometimes it's sideways for a short period and then continue with the downtrend. So there are multiple scenarios depending on what kind of news are there in the market affecting the liquidity allocation by various parties. Okay, so while we are having like around 2.5 weeks left towards this gap, it is already testing this 1.05 line. The volume has spiked up a little the past 3 days. Okay, we are in weekend now, so we probably have to wait till tomorrow, meaning Sunday afternoon for Americas, because that's the morning for Asia. So some institutions may start trading already. Okay, what about the purple line, the 0.86? Okay, after July 15th, there's another date. In case the decision is a continuation, there's another decision window right about 8 days after the 15th, 23rd of July. So if we look across, the significance is this one, October 10th. If you remember, that's US tariff announcement date last year. It went all the way very close to the 70 cents key level. So don't be surprised if the downtrend continues all the way to test the blue line, because not just October 10th. Remember the 2022 to 2024, end of 2024, okay, the fourth quarter. That accumulation cycle all happened except those 3 spikes, all happened below the 70 cents. Okay, if liquidity is really getting that bad, and whoever is going to sell Ripple may push the price back down to that accumulation range, 40 cents to 70 cents. Okay, there's still such a downside risk over here. So after Ripple, let's go to Chainlink. From a big picture perspective, very similar to Ripple, Chainlink is also around the panic over stage. But the difference is the price of Chainlink has already entered the 2022-23 accumulation zone. You see it has dropped below the green key level of $8. That's where around the top of the accumulation cycle for that entire 504 days, almost a year and a half. Okay, so let's expect more up and downs to come. That's a typical movement within the accumulation cycle, like what it happened over here on the left, right? Short-term view. A lot of dates we talked about, okay, because there were multiple occasions, and on the 14th, okay, it confirmed it broken out, but it developed into just a wider downtrend. So initially, it was a steeper decline. And we talked about this by June 24th. We will have an answer because there was the 2C's decision right over there. And the confirmation came in. You see the long wick over here. The bears hammered the price back to below the $8, while the bulls were trying to take the chance to break outside of this channel, but they failed. And then they dropped to test this $7.2 intermediate support line. Okay, that's where the beginning of the month tested, as well as the February 6th set this level. Okay, remember we talked about that February 5th and 6th, those two huge volume bars and huge price breadth, those are commitments from bigger players. Okay, and they set the price or the bottom, short-term bottom right over there. But things are changing. You see how the price dropped below and then, people buy over there, but this time the volume is much lower. So be careful what's going to happen. Okay, because like I said, the accumulation in 2022 to 2023, October, range from $5 to $8 for the case of Chainlink. So if this downtrend continues, which we already tagged in previous session, by the beginning of July, less than 10 days time roughly, then the 2C's decision comes in. It can happen sooner by breaking the 7.2, and it will continue to test until the point, if it really comes down, okay, if we extend this channel box, that's pointing towards somewhere in mid-August. It's too early right now to draw that. We'll get back to it in the future sessions. Now that this short-term downtrend is confirmed, changed, let's use the center line. If you're new to this channel method, I name it the air hockey method. So if you have played this game, imagine those two are the boundaries of the channels. And the center line is an additional line where you see the puck bounces along those three lines. Okay, that's why we are seeing not only bounces sometimes along those horizontal levels, but along this kind of slopes, center line of the slopes. It doesn't have to cut the channel in half. Sometimes it's skewed towards one side, and that's totally fine. That helps us understand, whether or not we would get certain rebound or rejection along the way. Okay, now let's move to Ondo. Big picture perspective. The automatic rally might have happened. That's where I tagged it. The reason I said might, because Ondo has a very short history as a baby, right? So we have to be very careful when assessing the young folks compared to the more established ones, because there's no history for us to take reference. We don't know how strong are the diamond hands, okay? There can be a lot of paper hands over there. But this case, Ondo has been playing a strong game over here with higher than average volume over the past 6-7 weeks. And we're just expecting more tests to happen during the accumulation cycle. That's across the board. I can say almost no exception if they're going through such kind of Wyckoff cycle, okay? Unless all of a sudden one outlier is accepting some kind of big deals that, attract a lot of liquidity, then we can have exceptions. So looking at the short-term view, we already talked about this bigger downtrend, more gradual, but also this short-term downtrend that's steeper, way steeper. You see the difference in terms of the slope, right? We mentioned by July 4th, okay, this bounce, whether it is bouncing off from the support, going to test the center line of the downtrend, that's approaching somewhere around July 8th or 9th. The 4th is somewhere earlier, okay? because it has to break outside of this short-term downtrend in order to bounce up to test the center line. Okay, like what it did over here, just in the beginning of June. Okay, so it's not doing something crazy, it's just doing something along the trend. Okay, 30 cents is the immediate support key level. 24 cents, if you look at what happened back in February all the way to May, don't be surprised if the price continue with this downtrend, breaking the 30 cents and eventually come back to challenge the 24 cents. It's completely possible it can bounce along this downtrend channel box. Okay. Next, Stellar. Big picture, Wyckoff. Again, automatic rally, coming back down for more test. This range was pretty close to, or actually around the top of the accumulation cycle back in 2002, 2003. There's still a chance for that to come back down to that range. Okay, no crypto project is able to escape this kind of fate. Bitcoin may be an exception. Ethereum, slightly more risky than Bitcoin, reaching to the previous low. Okay, the rest of the crypto projects, almost none of them are able to be immune to that kind of drop. So be cautious, that downside risk is always there. Okay, I just want to explain to you, if you look at the chart over here, after the selling climax, it climbed up sideways, sign of strength came in, it still was able to drop back to the red line. All right, so that's what I'm explaining. Even if it started sideways higher, it doesn't mean it can't come down to the lower levels. So again, big picture perspective, Wyckoff lens, accumulation, more tests to come. Short term, micro view. There are multiple lines over here. Just want to quickly check where that double yellow dash line comes from. Let's just keep one. And extend this one over here. So what's happening right now is that the price has dropped from the ceiling after testing the ceiling of that downtrend, fallen through this short-term support of 18 cents. You see why there's a line over here. This trading over here showing that's a support. These trading over here showing that's a reference level as well by getting or being rejected. Now it is back down to that level. Okay, this line turns resistance again. Just that it is finding support from the previous uptrend support line during mid-April all the way to mid-May. That's why we're seeing some support around here, because there's dual support, one from the purple key level of 17 cents, one from this previous uptrend support. However, if it manage to trade sideways towards the edge or the ceiling of this current downtrend, the date indicated by this gap is around the 17th of July. All right, unless something magically happens, a lot of money comes in, then it can test those two triangles in early July. The second one is 11. That's the red line, 19 cents 50. Okay. So for XLM, the immediate key level support, 17 cents 20, the purple one. But look at what happened over here during February all the way to end of May. The lowest support over here during that short-term period was 0.138, the light blue key level. And if we look back, that's the lowest point since January 2025. Lowest level right over there. But we all know what happened 2022 to 2024. So be careful, okay? This kind of drop if it continues, especially if volume continue to rise or sustain at this level. Because if you, excuse me, look at this level over here, it's higher than the average for the entire 4 months since January 2026, all the way to May 2026. This selling is still higher than the average over there. So I am a bit conservative as to what can happen, if that volume continues. But big picture, Wyckoff. Here we see the sideways movement. Again, a very short history, although we have the 2022 to 2024 period, which is better than having none. Those two periods shown as whether it's shorter accumulation or longer accumulation, it can go to the red key level of $49.50. Just in February, that has already shown us it's a possibility still in 2026. So while it is traveling sideways, as always, we talk about subsequent tests can go lower than even the selling climax itself. Sorry, I'm trying to get the tag over here across to Quant. So the red line is still possible from a big picture perspective, while we are waiting for a sign of strength to come to retest the $81.50 or slightly higher. All right, so the sign of strength is where price advance with volume. All right, I'll do that later. So micro view. The price has come back down. So the base case, this sideways movement, the price has come back to below the short-term support of $66.99. So right now it is trying to hover along this line. We have seen a short period of testing back in February-March period. The price came down to test at $61. It can still happen that way. So with all these that are happening, this uptrend is broken, but this shows us a bigger price spread downtrend. That's potentially what's happening right now. Okay, sometimes we have to keep adjusting our lens to see what actually is going on. So if this is really the case, there are two triangles, right? One over here is July 10th. The other is 26th. So one over here, one over here. The reason I copy or duplicate this first, because that's 26, I only need to change one digit, the second tag as well. And that's easier, right? When you adjust your charts. So somewhere around July 10th or 11th, doesn't matter. Sometimes it happens a day or two earlier or later. So those are the two dates. If the sideways trend continues, the 2C's decision has to come in, whether it is going to continue with the downtrend, meaning breaking these support levels, or making a change outside of this downtrend. That change is just a continuation of the sideways trend that has started sometime back in December last year. So look at what happened over here. In December last year, it dropped to below $81.50. It bounced up just to come back down to set the low point in February, 5th and 6th. Remember those 2 days, right? $56, $57. And then it climbed back to the 81.5. Now it is coming back down. It is just doing that for the entire over half a year. Okay, that's for Quant. Now, taken together, the developments we discussed point toward one recurring theme. The conversation is shifting away from whether tokenization is technically possible and toward whether institutions are willing to trust the infrastructure. That distinction matters. Announcement can change sentiment for a few days. Infrastructure adoption, regulatory compliance, and capital allocation determine whether narratives becomes durable over multiple market cycles. For sophisticated investors, the key question isn't which headline sounds the most optimistic. It's which developments produce measurable evidence over time. See you in the next video. Thank you.